All right, here we go. So this is our free response questions, the three that you're looking at. All right, so this will serve as our a little review, kind of walkthrough slash answer key, whatever you might want to call it. Make sure after watching this, right, any questions you have, bring them tomorrow because right, this is going to be on that quiz. Right, we'll be asking some questions about the foreign exchange market. We'll have some multiple choice questions as well tomorrow. But let's get started here. So right here is what we're looking at. Right, number one, we'll start with that one. Assume the United States economy is operating at full employment, right, and they want us to draw that graph with labels. So this goes all the way back to the beginning, right, and hopefully that is, this is the easiest part of this FRQ, right, because we've been doing this since, well, about, what, 4 units ago. All right, so here is our equilibrium. We got PL1 and Y1, and this is full employment, right? So our long run aggregate supply curve goes right through that equilibrium. And there's your first part. Now, part B here. Assume that personal savings in the United States increase. They want a loanable funds graph showing that impact on real interest rates. All right, so let's go down a little bit. This is part B, and we're going to draw our loanable funds graph. All right, so we got interest rates, which are real in the loanable funds, quantity loanable funds. Make sure we're good with our labels. You get points off for labels. Right. And here's our current equilibrium. Call that R1 and Q1. Now, remember that in this market, savers are supply. Demand, that's investors, right? So this question is saying personal savings increase. So that means that our supply, therefore, would increase, right? That supply is how much money is put into banks, right? Our savings accounts, right? So that's R2. Let me go down to Q2, and there it is. There is the change in real interest rates, a decrease in real interest rates. Now, based off that, I'm just going to put this over here, CI. They give you two questions. One, will interest sensitive expenditures increase, decrease, or remain the same? Anytime you see that word, that interest sensitive expenditures, right, that's just investment. All right, and we know, or should know, hopefully, that when interest rates go down, investment increases, right? So domestic investment there increases. And that part two of that question, they want to know what's going to happen to the rate of economic growth. Well, that's just what's happening to AD, right? Because C plus I plus G plus NX, so there's your I. Well, if investment increasing, that means that economic growth is increasing. So we're going to say increase because investment increase. All right, and there's your explanation to it as well. All right, so now we go to part D. Assume that the real interest rate of the Eurozone increases relative to the real interest rate of the United States. Draw a correctly labeled graph of the FOREX for the euro and show the impact of the change in the real interest rate on each of the following. First thing is they want to know the exchange market for the euro. So that actually means you only need one graph here. It doesn't mean you can't draw two. In fact, I would suggest it. I think it's easier to draw two in the beginning. If you're able to just kind of jump right to it, you got it, then go ahead and just draw one. Now, the other part of this is look down here, and they're pretty much right here. Now, I told you, like, they'll give you the perspective to take, right? And right here, they say, what's going to happen to the demand for the euro? Right away, we need to think, who controls the demand for the euro? Well, the United States does, right? We control the demand for the euro. We control the supply of our own currency. So there's your perspective. They're saying, this is what's going to change. Something's happening to this. So that means we're taking that United States perspective. All right, so if we go back to here, let's draw something. Let me focus there. All right, this will be part D. Like I said, they only really want the market for the euro. All right, so I'll start with This will be our euro quantity, euro, right? Bottom, right? So this is the market for the euro, demand and supply. All right, we got exchange rate 1 and quantity 1. Okay, this is really the only one you need, but let's take it from the perspective of why not, and let's just draw the other one as well as good practice, right? So the other one would be our quantity of dollars, right? And here we go, we got demand and we have supply. Remember, questions asking what's going to happen. So the real interest rate in the Eurozone increases, right? We impacted demand. They want to know what's going on with demand. So that means we're taking the United States perspective. Well, if interest rates are higher in the Eurozone, people in the United States are going to want to put their money into the banks in Europe, right? Because you get a better return. In order to do that, they need euros, right? So we increase the supply of the dollar in order to demand euros, right? So there it is. There's your increase in demand, right? And what does that do? Well, that appreciates the euro. And over here, that's going to depreciate the dollar, right? So there's your first one. There's your graph of the euro. This is the one that you need. And what we find is that we increase the euro. Why? Well, because United States investors are attracted to the higher interest rates. That D part 2, we get value of the euro relative to United States dollar. Well, the value of the euro appreciates relative to the dollar, okay? And then that final part here, all right, E. Put it right there. Assume the United States current account balance is 0, right? Based on the change in the value of the euro, will the United States account balance now be in surplus, deficit, or remain at 0? Very long-winded way of asking what is going to happen to exports because of what happened to the foreign exchange market. Well, we know that United States currency, the dollar, depreciates. That means that our currency has less purchasing power, and it means that our goods are cheaper. If our goods are cheaper, people are going to buy our goods. We're going to be exporting more. So that means that our current account balance, import-exports, will be in a surplus because we are exporting more than importing. All right. So make sure that that's final part. Depreciation, good for exports. Okay. And there is your first problem. All right, let's look to number 2. All right, so we got a United States firm sells $10 million worth of goods to a firm in Argentina where the currency is the peso. How will the transaction above affect Argentina's aggregate demand? Well, we know that aggregate demand is made up of exports. In this case, the United States is exporting, Argentina is importing. So we would say that Argentina's aggregate demand is going to decrease. Explanation? Well, it's because they are doing the importing, which would then be greater than exports, right? And there is your explanation. Part B. All right, assume that the United States current account balance with Argentina was initially 0. How will the transaction above affect the United States current account balance? Well, we would say that the current account would be in surplus, right? Because, well, why? Well, exports are a part of the current account, right? And in this case, exports are greater than imports. And we know that those two things are current account issues, right? So those first 2 questions really just asking the same thing about what's happening with exports and imports for the various countries. All right, part C, using a correctly labeled graph for the foreign exchange market for the dollar, all right, show how a decrease in the United States financial investment in Argentina affects the following. All right, once again, This is what I'm talking about when you get a perspective, all right? I would always look to this. Here you go. The supply of the United States dollar. That's what they are worried about. Who it has control of the supply of the U.S. dollar? Well, it's the United States, right? Americans who have the dollar, right? They control the supply of it, right? That means that we are taking this from a U.S. perspective. All right, so let's draw out our graph. Once again, they're only asking for 1. You can certainly draw 2 if you would like. All right, but let's go with 1 right here. And we go peso to dollar bottom, and market is dollar quantity on the bottom here. So demand and supply. And like I said, just for good practice, let's draw the other. Doesn't hurt, right? Dollar to peso quantity. Peso. Demand. All right, so we're taking the United States perspective, right? Now, the question says that the United States has decreased investment in Argentina. If they're decreasing investment in Argentina, that means they do not need pesos from Argentina, right? Think about it that way. Well, if I'm not putting money in that country, if I'm not putting money in their businesses, why do I need the peso, right? So you could start over here and say, well, demand, because that's what America, the United States controls, right? Demand has decreased for the peso because people aren't investing. And if the United States has lessened their demand for the peso, that means that they're supplying less dollars to the foreign exchange market because they are not needing the other currency. Right? This is the graph right here on the left that you need, and that's the shift, a decrease in supply. Right? Do not get confused in this question by asking, like, this is not asking necessarily about financial account, right? If you look at the financial account, you get kind of caught up in interest rates, and then you think, all right, well, interest rates are doing this. If they want you to draw the supply loanable funds and think about interest rates, they will tell you interest rates specifically. This question is simply saying that there's less investment going to Argentina from the United States. People are not demanding the peso because they're not putting their money there, all right? That second part now, part C, subset 2I, value of the United States dollar relative to the peso. Well, we see right there that the value of the dollar appreciates, right, going up. All right, and then finally, this last part, all right, D, suppose that the inflation rate is 3% in the United States and 5% in Argentina. What is going to happen to the value of the peso relative to the United States dollar as a result of the difference in inflation rates? All right, think about your shifters in FOREX. All right, here you go. It's inflation. What shifter is it? Well, there's going to only be one, and it's price level, right? What this is basically saying is that the price level in Argentina, 5%, compared to the United States is 3%. So prices in Argentina are higher. If prices in Argentina are higher, that means that the United States does not want to buy their goods. Right? It could also mean that Argentinian citizens are they're getting out and they're buying United States goods, right? But let's keep the United States perspective. Why would you buy Argentina's goods if their prices or if their inflation has increased? You wouldn't, right? So therefore, you would once again demand less of the peso, and that would mean that the peso would depreciate because United States is demanding less of it or supplying less of the dollar because prices are too high, all right? And there is your problem number 2, all right? So let's go to our last one. Number 3, another little bit long one. Get rid of the paper. All right, and we have the economy is Czarland operating below full employment. So that means we had a recession with a balanced budget. And we start with drawing just our macro model with our labels. So let's go at it. 3, here's A. And our labels are what? Y1 and PL1, and we're below full employment, so we're operating in a recession. So here's our long run aggregate supply, and there is your YF label. All right. All right, B, if Zarland increases government expenditures and taxes by equal amounts, can aggregate demand increase? All right, well, this is your balanced budget multiplier. If we remember, so B, right, balanced budget multiplier equals 1. When the government increases spending and taxes by the same amount, AD increases by how much you spend, right? By that balanced budget multiplier of 1. So the answer is yes, aggregate demand can increase. And your explanation really is because spending multiplier is greater than the tax multiplier. So yes, because spending multiplier is greater than tax multiplier, a little shorthand there. All right, it would go up by how much you spend. Don't forget about that balanced budget multiplier. All right, part C. If Zarland decides to pursue an expansionary monetary policy, what open market operation should the central bank undertake? So expansionary policy, open market operation. Remember, that is the buy bonds, right? Buy big money, increase the money, expand it. Open market operations, always dealing with bonds. Part D, using a correctly labeled graph of the money market, show the short run effect of that operation on interest rates. All right, so now we got interest rates nominal. Let's draw out our graph. Move that down just a bit. Quantity of money, money supply, and money demand. All right. Expansionary policy increases the money supply. All right. And what that does is drives down interest rates. All right. Part E, as a result of that interest rate change associated with this graph, will the supply of Zarland's currency in the foreign exchange market increase, decrease, or remain the same in the short run? Once again, pay attention here, right? So this is Zarland, so they want to know what's going to happen to the supply of Zarland's currency. Who controls the supply of Zarland's currency? It is Zarland, right? They have low interest rates. If you're thinking about Zarland, right, they would not want low interest rates, right? They would look somewhere else, right? So let's just say, I don't know, we got Zarland's fictional, but let's take the dollar, right? And this is quantity ZAR, right? So this is Zarland's market, demand, and supply. And the other one, we're just going to call the dollar, right? Quantity dollar, supply or demand, and supply. They want to know what's going to happen to the supply. Well, low interest rates, people don't want that, right? The United States, in this case, in this fictional kind of case, would have higher interest rates, right? Because that's what's happening here. So if the United States, we just assume their interest rates stay the same, well, then Zarland would look for better interest rates, and they would increase the supply of their own in order to demand another, right? This is the graph, or actually we don't even need a graph, but that's the one we're focused on, right? Because they tell you supply of Zarland's currency, that means that Zarlandians, they're the ones who control that. They would look for better interest rates. They would increase the supply, right? Now we go to that part F. Based on that answer, will Zarland's currency in the foreign exchange market increase, decrease, or remain the same? All right. Well, value is decreasing, right? It is depreciating. It's exactly what we just showed on that graph. And then finally, G, following the change in the value of Zarland's currency that you identified, will Zarland's exports increase, decrease, or remain the same? Well, depreciation means that goods are cheaper, right? So their exports are going to increase because their goods are now cheaper because of depreciation. And that is exactly your explanation right there. All right. So there you go. That's 1, 2, 3 in free response questions. come with questions tomorrow in class. All right, I'll try to answer everything I can. We'll do some multiple choice. We'll start with these, and then we'll end class with a foreign exchange market FRQ quiz. All right, see you guys tomorrow.